It's June 12th, and a few million people are staring at the same screen, watching one ticker symbol load. SpaceX is officially public, the biggest IPO the world has ever seen. Within minutes of the opening bell, the price starts moving. Up, fast. For a lot of people watching that climb, it feels like a siren going off, a signal that says, get in now or get left behind forever. I want to slow that feeling down before it makes the decision for you. Back in 2012, Facebook went public to some of the loudest hype a tech stock had ever received. It opened, it wobbled, and within 4 months, it had lost more than half its value. Now, flip to 2024. Reddit went public with almost no fanfare and a flat first session. A year later, it had more than doubled. Same mechanism, opposite outcomes. The opening day told you nothing useful in either case. So, before the chart convinces you that you're watching something historic happen, let's run the numbers nobody puts on screen. I want to be upfront about something, because I know how comment sections go. This isn't a video arguing SpaceX is a weak company. It isn't. It builds and reuses rockets at a rate no government space agency has ever matched, and its satellite network reaches well past 100 countries. None of that is in dispute. What I want to dig into is the gap most people never separate in their heads. The difference between owning a remarkable company and making a smart investment in that company on one specific day, at one specific price. That gap is exactly where regular investors get hurt on a deal like this. Here's what almost nobody explains clearly. Going public isn't a single moment where everybody walks up to the same counter and pays the same price. It's a sequence, built deliberately, and the people who built it stand at the front of it. By the time you're able to place an order, several rounds of buying have already happened without you. Most of the energy you feel on launch day is designed to make you forget you showed up late. So here's where we're headed. We'll look at what's actually inside the business. We'll put the price next to the real financial results. We'll map out who got to buy first and why. We'll look at what typically happens to stocks that debut this loudly. And we'll finish with the mechanism almost nobody watches for, the one that catches latecomers months after the hype cools. By the end, you won't need me to tell you what to do. You'll be able to work it out yourself. Let's start from the beginning, because everything after this depends on it. For most of its life, SpaceX was private. Ownership sat with founders, employees, and the venture funds that backed it. There was no app, no ticker, no way in unless you were already inside that circle. An IPO is the event that breaks that wall down. The company sells a slice of itself publicly, and from then on, shares trade freely on an exchange. SpaceX listed on the NASDAQ, with its first trade on June 12, 2026. Here's the detail buried under all the celebration, and it's the most important thing to understand before touching this stock. There are two prices, not one. The first is the IPO price, $135 a share, set behind closed doors between the company and its underwriting banks, before anyone outside that room could buy in. Those shares went almost entirely to large institutions and a select group of insiders who'd locked in allocations days ahead of time. The second price is the one you'll actually pay. Once trading opens, the price is whatever the market decides, tick by tick. For a deal this hyped, that price lands well above $135. In SpaceX's case, it didn't just land above it, it broke clean away from it. Within days, the market had pushed the company's value to roughly $2.8 trillion, over $1 trillion above what the company itself had targeted going in. Hold on to that gap. We're coming back to exactly who benefits from it, and it isn't the person buying from their phone after the opening. Now let's talk about what you're actually buying underneath that number. SpaceX brought in $18.7 billion in revenue in 2025, up about 33% from the year before. Real growth. But here's what doesn't make the headline. SpaceX didn't turn a profit. It lost close to $4.9 billion, a sharp reversal from a profit of nearly $800 million the year before. What changed is where the money went. SpaceX folded in a new AI division tied to Musk's separate AI venture, and that division alone reportedly posted over $6 billion in operating losses last year, while contributing only a small slice of revenue. Of the roughly $21 billion the company spent on capital projects in 2025, more than half went into data center infrastructure for that AI push, not rockets, not satellites. So where's the real money coming from? Not where most people assume. The actual launch business, the rockets, made up only around a fifth of total revenue and grew the slowest of any segment. The real engine is Starlink, the satellite internet service, which generates roughly 60% of total revenue and is the one division that's genuinely, reliably profitable. The AI division is the smallest revenue contributor and by far the biggest source of losses. In plain terms, buying a share of SpaceX mostly means buying Starlink, with a slow-growing rocket business and a cash-burning AI venture riding along behind it. Those two could become valuable someday. But someday is carrying a lot of weight in that sentence, and the stock's price is already behaving as if that future arrived. So let's look at the number everyone's talking about. The IPO priced SpaceX under $2 trillion. Within days, the market pushed that to roughly $2.8 trillion. Sit with how fast that happened. 18 months earlier, private investors valued the company at $400 billion. By December 2025, that doubled to $800 billion. By the June listing, the target had jumped near $2 trillion, and within days of trading, the market pushed it past $2.8 trillion. That's roughly a seven-fold jump in about a year. Did the business grow sevenfold? Not close. Revenue grew 33%. The satellites didn't get 7 times more capable. What multiplied was the story, far faster than the numbers could justify. Put that $2.8 trillion against $18.7 billion in revenue, and you get a price-to-sales ratio of roughly 150. Investors are paying around $150 for every dollar this company brought in last year, for a company that lost money on top of that. For context, before this IPO, the most expensive large stock in the S&P 500 was Palantir, around 73 times sales, already considered dangerously stretched by most analysts. The average S&P 500 company trades around 3 times sales. SpaceX came in at roughly 150. That's not a different category of expensive. That's a different planet. This isn't just one skeptic's take either. At least one major Wall Street research firm initiated coverage with an outright sell rating, putting a price target near $115, nearly 30% below where the stock traded at the time. When a serious research desk slaps a sell rating on the biggest IPO in history within days of it opening, that's a real warning, not noise. Here's one more gut check. Starlink, the only consistently profitable piece, generates several billion dollars a year in operating income. Value it generously, the way investors price a thriving tech company at 40 times earnings, and you land around $250 to $300 billion. The whole company is being priced at roughly $2.8 trillion. So the one part of this business that's actually making real money explains maybe a tenth of the price tag. The other 90% is a bet on rockets and an AI division currently known mostly for burning cash. So if the price is this stretched, why does the stock keep climbing anyway? Because of who's standing where in line, and that part isn't an accident. Picture the $135 price as the start line of a race. The institutions and insiders who got their allocations from the underwriters take their position quietly, days before the bell. That's lane 1. And you're not in it. Here's an unusual wrinkle. Most blockbuster IPOs hand retail investors scraps, maybe 5 to 10% of the offering. SpaceX opened up a noticeably bigger slice through popular trading apps. Sounds generous. Be careful with that read, because Wall Street rarely widens a door out of generosity. Demand for a deal this famous still wildly outstrips what's available, even with a bigger retail slice. Most people who want in don't get shares at $135. So they buy on the open market instead, at whatever price the crowd has already bid it to. And who's usually selling into that rally? Often the same people who got the cheap seats at the start. That's the handoff. Risk passes from the people who bought low and early to the people who show up after the price has already run, convinced they're early. They're not early, they're last, and they're paying a premium for it. One number drives this home. On opening day, the gap between the $135 insiders paid and the price the market actually set represented tens of billions of dollars in value, transferred straight to whoever held shares before trading began, one of the largest single-day transfers in IPO history. None of it required the business to do anything differently. It just required the public to show up excited. Now, what tends to happen after debuts like this? There's a trap here sneakier than the stock simply falling. Once a company reaches a certain size, it automatically qualifies for major stock indexes, the kind sitting inside most retirement accounts. When a stock joins an index, every fund tracking it is required to buy, no opinion allowed. That forced buying can genuinely push the price higher in the weeks after listing, regardless of what the business is worth. If you hold a basic index fund in a 401k, which most people watching this describe, you may now own a sliver of SpaceX automatically, at whatever price the market happens to set, without ever deciding to. That inflated price isn't a floor protecting you. It's a launchpad for insiders looking to exit, and you're the one supplying the liquidity that lets them leave. Underneath all of that sits a brutal pattern. Long-running research tracking thousands of IPOs shows more than 90% eventually trade below their first-day low at some point. Not their high, their low. Which brings us back to the start. Facebook fell more than half in 4 months after its hyped 2012 debut. Rivian collapsed roughly 95% from its peak after one of the most electric debuts in years. Coinbase and Robinhood both fell over 85% from their post-IPO highs at various points. Reddit, by contrast, opened quietly and more than doubled within a year. And then there's the counterexample everyone reaches for. Tesla, up an enormous amount since its 2010 IPO. But notice the asterisk nobody mentions. To capture that, you had to sit through a stretch where the stock dropped more than 60%, plus several other brutal drawdowns. Almost nobody holds calmly through a 60% loss in a company the internet says is finished. Most people sell at the bottom, not the top. The lesson isn't that hyped stocks always crash. It's that a loud open and a quiet open are equally likely to reverse within a year. The excitement you feel watching the chart climb isn't information. It just feels like it is. There's one more piece of this machine, and it's the one that catches people off guard hardest because it's scheduled in plain sight and people still miss it. When a company goes public, insiders are typically barred from selling immediately. That's the lockup period, usually around 180 days. The logic: if everyone holding cheap pre-IPO shares could dump them on day one, the price would crater instantly. The lockup just delays that pressure. But a dam doesn't make water disappear. When the lockup lifts, that supply can hit the market at once, often right as the hype fades and fewer buyers are left to absorb it. SpaceX has layered this further, with insiders unlocking shares in stages tied partly to the first quarterly report, and more around the standard 6-month mark. Musk has reportedly committed to holding his stake longer, which is reassuring until you realize that commitment doesn't apply to almost everyone else. The timing isn't accidental. These windows tend to land right as media coverage dies down, and the crowd of eager buyers has thinned. Fresh supply meeting fading demand is exactly what drags a price lower, and it's sitting on a calendar insiders can read in advance, while most retail buyers never check it. Picture it as scheduled waves, not one cliff edge. each one another group of early holders, finally free to sell. With retail investors who bought near the top, usually standing on the other side, absorbing it. There's a blunt term for that role: exit liquidity. Let's bring this together with the only question that matters. Forget predicting next month's price. Nobody can do that reliably. Instead, measure the bet itself. What would SpaceX actually have to achieve just to make buying it at this price worthwhile? Set the bar as low as we fairly can. Forget getting rich. Just ask what it takes to match a plain index fund, roughly 10% a year. Starting from $2.8 trillion, growing 10% annually for 10 years, gets you to around $7.3 trillion a decade out. Now ask what the business needs to look like to justify that. Assume generously that SpaceX is, by then, mature and richly valued at 15 times sales, a multiple reserved for elite growth companies. Even with that generosity, the math requires roughly $490 billion in annual revenue. Sit with that. $490 billion, up from $18.7 billion today, roughly 26 times current revenue. To get there in 10 years, SpaceX needs to grow revenue by close to 38% every single year for a decade straight, without a stumble. Almost no company at this scale has ever sustained that for 10 years. And that brutal growth rate is only what's required to tie an index fund. Beating it requires even more. So the honest conclusion isn't that SpaceX will fail, it's that at this price, you're not buying a great company at a fair price. You're prepaying for a near-perfect decade and getting an ordinary return only if that decade actually arrives. So, where does that leave you? If you genuinely believe in this company, an unreasonable price doesn't mean never touch it. It means there's a smarter path than the two loud ones. Option 1 is chasing the pop, buying after the institution's already locked in gains, right before the supply waves hit. We've just spent the last several minutes on why that's the worst seat in the house. Option 2 is writing the whole thing off out of spite, throwing away a genuinely extraordinary company on principle. The third option costs nothing but patience. Let time do the work. Hype is trying to rush you past. In a few months, SpaceX will report real results as a public company, numbers you can hold it to instead of projections wrapped in excitement. The mechanical index buying will have run its course. The first wave of insider selling will have worked through the market. The price will get a real chance to settle near what the business is worth, instead of where launch day adrenaline pushed it. None of that requires predicting anything. It just requires not rushing. The truly great companies of the last few decades stayed investable for years after their debut. You didn't need to own them on day one to do extremely well. The market rewards patience far more reliably than it rewards speed. What's being sold to you right now as a once-in-a-lifetime moment is, almost always, just a stock that will still be there next quarter, priced by reality instead of a countdown clock. If there's one idea worth keeping, it's this. The right question was never, where does this go next? It was, what would this company actually have to do to be worth what I'm paying for it? That question works on any stock you ever consider, not just this one. Run it before you buy, not after. The number on the screen the day this stock opened was loud. The chart looked unstoppable. None of that changes the math underneath it. SpaceX is an extraordinary company by almost any measure, but the price the market handed it on day one already assumes a miracle arrives on schedule. Watch it if you want to. Just don't mistake the noise for a reason to act.